Hey, so we've been doing this a long time. We tend to get a lot of questions over the years, and some of them are the same questions. So today I thought we would tackle some of those questions because I'm sure someone out there is thinking what someone else has submitted into us. So let's go through these. Here's one of the questions that comes into us a lot. Should I wait for the real estate market to crash before I get into real estate investing? So here's what we can tell you. Our family's been in real estate in some capacity. Our mom was renting out rooms in Toronto in the 1970s. Our father was flipping homes in the 1980s. We got caught in the biggest real estate crash Canada has ever seen in 1990. Nick and I got started in the late 90s, early 2000s ourselves. So as a family, we've been in this through decades. And what I can tell you is that everybody thinks they can wait for the crash. But if you're trying to wait for a crash and it never comes, you are out of the market for a long time. And the way to make money in real estate is to not time the market, but it's to spend time in the market. So our advice has always been get in the market in a way that you can survive the inevitable ups and downs. So don't try to time it. Don't try and wait for the crash. Get in and survive. That's how we've seen people make money in real estate. But if you think you can time the market, have at it. But I would throw this at you. If the market does crash, it tends to come from a credit problem. So either banks aren't lending or perhaps interest rates spike up. In that type of environment, it's likely going to be very difficult to get any financing. You're going to have to get super creative with sellers to acquire properties. Not that it's impossible, but just know some of the traditional banking avenues might not be available because there's a crash, and that's something to keep in mind. Okay, do you suggest managing your own investment properties? They have questions. This comes in a lot. These are actual questions I'm reading out to you that we've had submitted recently. They have questions about investing close to home. How do you manage a property further away? So Nick and I managed our own properties when we got started for over 10 years. And what that taught us is how to deal with tenants, how to manage maintenance, how to manage general contractors when you're doing larger repairs. So when we did eventually start handing off some properties to property managers, we knew the costs, we knew what to expect, we knew how students react, we knew how regular tenants react to different things. So we had the experience that allowed us to manage the property managers. So for us, it was really important to manage the properties when we're getting started. We actually tell all investors to manage your property yourself when you're starting out for at least a year before you hand it off. But many families are busy, and if you're just getting into this and you absolutely have no time, you have some kids at home, absolutely get a property manager. There's no harm in doing that. It's going to cost you, depending on the property type and the area, I'm going to ballpark about 8% of the gross rent is what a property manager is going to cost you, roughly. Don't hold me to that. It's roughly going to be the cost. And as far as investing close to home, we always advise investing within an hour to two drive of home. And the reason for that is it opens up a lot of options, because even if you live in downtown Toronto, if you're willing to drive an hour or two away, you get some different communities that have much better numbers in our eyes. So just having said that, I'm thinking some people don't have cars. We've had some investors do daily rentals of cars. I think it's like, I can't remember, Zippy car rental, kind of like a day or even by the hour rental car to go out to different rental properties. So it's totally possible. But as far as like buying a property halfway across the country or in the US, it's also something that we have a lot of investors do. Nick and myself, so my brother and myself, we just prefer to buy properties close to home because we feel that's where we can get an information advantage. We know where the great communities are. We know where the demand is. We know where the rents are. We know the lawyers, the mortgage brokers, the home appraisers. So we have an information advantage. So we prefer to create that information advantage close to home because it's the easiest place to get it. So that's our thoughts on that. Someone else is asking, do your strategies work outside the GTA, outside of Ontario? So we don't have any strategies that we own. We're just implementing different real estate strategies like student rentals, legal second suite, straight rentals, pre-construction condos, renovating a property. I think the trendy name right now is a BRRRR, where you kind of buy a property, renovate it, rent it out, refinance it, and kind of repeat. So all these strategies work. These are all based on principles. Rent to own is another strategy. They work almost in every area we've ever seen. We have friends doing these strategies on the other side of Canada. We have friends doing these same strategies in the US. So when you're using a real estate strategy, they typically work anywhere. So yeah, we'll leave that one at that. Thoughts on short-term rentals, cottage rentals, Airbnb. So yeah, we have a lot of people right now, especially in the COVID era, where people are moving away maybe a little bit from Toronto more than they were in the past, absolutely killing it with vacation rentals and Airbnbs and vacation areas. So absolutely, we don't do it ourselves, but we do know people who do that. They do really well at it. The rents are super high right now. Something, if you're going to get started in that right now, to consider would be to check the rents, because they might not exactly stay as high as they are right now. Perhaps if people do kind of trend back to the city a little bit over the next year or 2 years, maybe the rents come down a little bit, and maybe they don't. But just if you're getting started in vacation rentals right now and you look at the current rents that people are getting, perhaps don't bank on exactly that amount when you're making your financial decisions on buying the property. But absolutely that works. We know people doing it up in the Collingwood area, basically all over Ontario, and Niagara-on-the-Lake area. I think Niagara-on-the-Lake specifically, so Niagara-on-the-Lake proper, I think they have some restrictions against short-term rentals. So we know people kind of doing it on the outskirts there, but we do know people doing it right across Ontario. Thoughts on Toronto condos and pre-construction condos. So we've always believed in buying resale real estate because that's how we can put our money to work the fastest. When you buy pre-construction stuff, you're typically giving your money to a builder, and then you don't get access to the property for 6 months, a year, year and a half, 2 years. And then even when the condo is complete, sometimes you're renting it out and you don't actually have the condo certificate. It's not actually your possession, your condo in your possession for perhaps a few months even after that. So we prefer resale. Now, having said that, Nick just bought a pre-construction condo. I might do something like that because I'm looking at a couple areas for my kids where I might want to buy some real estate. So we're not against them. It's just our preference is resale because we can get the cash flowing on the property right from day one. A lot of people love pre-construction because they believe they're buying low, and then when the property's closing, it's at a much higher price, so they're kind of baking in some appreciation there. And that's worked for a lot of people really well over the last 10 years, especially with Toronto condos. So we have nothing against it. It's just our preference to buy resale because we don't know what's going to happen to the economy in a pre-construction condo from the time we put down our deposit until the time we get the property. With a resale, it's usually going to be like 60 days we're taking possession. The economy can change during that time, but if rents are a certain amount, they're likely going to be similar 60 days later. We just have more variables that we can control with the resale. So that's why we prefer resale, but we're not against pre-construction, just a preference. What's another question here? Should I be buying properties through a corporation or individually? So 2 weeks ago, we did a video, a Rockstar Minutes video with John Paul McDonald, who's an accountant who went through this topic. So if you want to go back to a previous video, you'll see this discussed in more depth. But generally, most accountants and lawyers prefer you buying a property in a corporation. You get some, for liability reasons, there's some tax efficiencies you get from that. There's higher upfront costs. And something else that's not typically discussed is that when you're using a corporation to buy residential investment real estate, not all the banks in Canada like that. So you have less banking options. Some banks just will not allow you to close on a residential investment property inside a corporation. They'll only allow it in your own personal name. So just be aware of that. But we use corporations ourselves. If you think you're going to be buying more than one or two properties and you're going to be doing this for some time, corporations are likely the way to go. The best answer for this, because everyone's situation is different, talk to your accountant and your lawyer. And if you don't know an accountant or lawyer, ask around for friends and family who are using accountants who understand real estate investors. If you need more information on this subject, check out the video we did a couple weeks ago with John Paul McDonald on exactly this topic. Let me see if I can take one more. Okay, here's one. What's the typical upfront payment on a rent to own? This is interesting. I think Jay-Z and Will Smith, is that the headline I saw? They recently invested in an investment company in the US that are doing rent to own properties. It's getting harder for people to buy properties. So this company down in the States offers a rent to own option to tenants who eventually can buy the home. And someone sent me that. I think it was Mike on our team sent that over. That I think it's Jay-Z and Will Smith are investing in this company. But anyway, if you're not familiar with the rent to own, typically the way we have done these in Ontario is we typically do a 3-year lease. And at the end of the 3-year lease, the tenants have the option to buy the property. It uses 2 legal agreements, an Ontario Standard Lease Agreement and a second agreement called the Option Agreement. And in exchange for putting a rent-to-own tenant in the property, where they have the option to buy the property from you, the owner, on whatever you decide, but typically 3 years works out really well, they give you an option fee up front. Kind of, some people refer to it as down payment, but technically it's an option fee. And That option fee on rent-to-own properties we'll see from tenants over the years. The range, I guess, would be about $10,000 to $20,000. We've seen less many times, and we've seen more than that many times. But I was to give you a range on the money that you can expect to get from a tenant on a single family home type rental property, a starter home, would be 10 to 20,000. You, the investor, gets up, and that's in exchange for selling them the option where they get to buy the property at the end for 3 years. Now, they don't lose that option fee. That's basically part of their down payment that they're giving you in advance to buy the property from you 3 years later. And then you appreciate the property. Typically, we've been appreciating those properties at about 5.5%, which is historically below the averages. From 1969 until about 2 or 3 years ago, the Toronto Real Estate Board, the appreciation on average was about 6.2% over that time period. And the last 10 years, it's been higher. It's been just over 8%. So if we were to go back to 1969, the Toronto Real Estate Board, and go to today, I bet it's even higher than 6.2 because the last 10 years has been so aggressive. But you typically appreciate the property on a rent-to-own property from whatever you purchased at. You pick an appreciation rate, let's say 5.5%, 6%, whatever you're going to use, and you appreciate it by that amount 3 times compounded, and that's the buyout price where the tenant can buy the property from the landlord or the investor at the end of 3 years at that new price. That's it. Hopefully that answered some of your questions. Maybe we'll do this again. We'll wait to see if we get some feedback on this kind of stuff. Hopefully you're enjoying these Rockstar Minutes. Until next time, your life, your terms.